Canada launches $40 billion LNG terminal to supply Asia, bypassing U.S. routes. Trump slaps 10% tariff on Canadian energy exports. Ottawa retaliates with global gas pivot. In a single week, the future of North America's energy map was redrawn. From the icy coast of British Columbia, the GasLog Glasgow steamed toward Japan, marking the first LNG shipment from Canada to Asia that didn't pass through the U.S. Back in Washington, officials scrambled, caught off guard as allies turned elsewhere and pipelines went quiet. The United States once held the key to North America's gas flow. But what happens when Canada changes the locks? For decades, energy cooperation between Canada and the United States was a symbol of continental integration. Vast natural gas fields in Alberta and British Columbia fed into an intricate web of pipelines stretching into Washington, Oregon, and California. These cross-border flows powered homes, fueled industries, and underpinned energy security for both nations. The U.S. relied on stable Canadian supply, while Canada leveraged American infrastructure, especially export terminals along the Gulf Coast, to access global LNG markets. It was a win-win system: cheap gas for Americans, global reach for Canadian producers. But the balance began to shift. The first tremors came in the early 2020s as Asia's appetite for cleaner-burning fuels surged. Japan, South Korea, and China, burned by Russian supply shocks and Middle East volatility, sought long-term LNG partnerships. Canada, rich in resources but lacking export terminals, saw an opening. Construction on the LNG Canada project in Kitimat, British Columbia, accelerated with backing from Shell, Petronas, PetroChina, Mitsubishi, and Korea Gas Corporation, KOGAS. Meanwhile, political winds in Washington were changing. In March 2025, the Trump administration, under its America First energy policy, imposed a 10% tariff on all Canadian energy imports and a broader 25% tariff on Canadian goods. The move, meant to pressure Canada in ongoing trade talks, instead fractured a critical alliance. Suddenly, Canadian producers faced shrinking margins when sending gas south and growing incentives to bypass the U.S. altogether. By the summer of 2025, the long-standing energy interdependence between the two nations was unraveling. Kitimat wasn't just a port, it became a pivot point. As the LNG Canada facility opened its gates to Asia, the continent watched a quiet revolution unfold on the Pacific coast. And for the first time in decades, the U.S. wasn't in control of North America's energy story. America's gamble. The decision came swiftly and with political calculation. On March 4th, 2025, the Trump administration announced sweeping tariffs targeting Canadian exports. A 25% tax would hit all Canadian goods entering the U.S., with an additional 10% levy specifically on Canadian energy products, including natural gas. The justification: protecting American jobs and reasserting dominance in global energy markets. "We won't let foreign gas undercut American strength," President Trump declared during a rally in Pennsylvania. But the economic logic was questionable. Canada had long served as a stable, friendly supplier. Its pipelines into the U.S. Midwest and West Coast supported domestic gas needs, and even filled shortfalls in peak demand seasons. Tariffing Canadian gas didn't just disrupt trade, it attacked a foundational piece of the North American energy ecosystem. The immediate fallout was swift and painful. Natural gas exports from Canada into the U.S. dropped by more than 30% in Q3 of 2025. Contracts collapsed, particularly in the western states. Oregon and Washington, which relied on consistent pipeline flows from Alberta and BC, saw spot prices fluctuate wildly. In California, utilities began warning of winter shortages and higher heating bills. The shock extended beyond consumers. Enbridge, one of North America's largest pipeline operators, was forced to cancel a $1.4 billion expansion project through California. The reason: declining volume, rising regulatory uncertainty, and investor flight. The same infrastructure that once promised continental energy dominance was now underused, politically exposed, and economically unsustainable. Meanwhile, America's own LNG export system, centered on the Gulf Coast, faced its own constraints. Congested ports, long shipping routes via the Panama Canal, and high methane emissions made U.S. LNG less appealing to increasingly ESG-conscious Asian buyers. Ironically, the tariffs that aimed to secure American energy primacy created a vacuum. The U.S. cut off its most loyal energy partner at the very moment that Asia was looking for clean, reliable, and geopolitically neutral suppliers, and Canada was waiting in the wings. Canada's strategic countermove. When Washington slammed the door, Ottawa quietly opened a new one. Just 4 months after the U.S. imposed tariffs, the GasLog Glasgow set sail from Kitimat, British Columbia. It was a moment years in the making. The inaugural shipment of Canadian LNG to Asia, entirely bypassing American soil. On board, liquefied natural gas destined for Japan, purchased through a contract arranged by Petronas and Kogas. This wasn't just a commercial event, it was a geopolitical signal. LNG Canada, a 40 billion Canadian dollar project, had always been ambitious. Backed by energy giants Shell, PetroChina, Mitsubishi, Petronas, and Kogas, it boasted a 14 million ton annual capacity and access to some of the world's cleanest hydroelectric power. The facility's carbon footprint was among the lowest of any LNG terminal globally, a selling point tailor-made for ESG-focused Asian buyers. But what made Kitimat truly strategic was geography. Unlike the congested and vulnerable U.S. Gulf ports, Kitimat offered direct access to the Pacific. Shipping times to Japan, South Korea, and China were slashed in half. 10 days versus 20 via the Panama Canal. No tolls, no choke points, no middlemen, and crucially, no U.S. regulatory strings attached. With trade tensions rising, Asian buyers hedged their bets. PetroChina and Kogas had already invested directly in the project, securing long-term offtake agreements. In July 2025, Japan signed a new 15-year contract with Canadian suppliers, citing logistical efficiency and sustainability as primary reasons. Even as the U.S. tried to woo Seoul and Tokyo with broader trade incentives, including a $350 billion U.S.-Korea investment deal, the gas narrative had already shifted north. Canada's pivot was intentional and quietly brutal. Instead of confronting U.S. tariffs with retaliation, Ottawa played the long game, building alliances, infrastructure, and regulatory credibility. The federal government streamlined export approvals, while provincial leaders worked closely with Indigenous communities to avoid legal roadblocks. Environmental groups, traditionally LNG skeptics, found fewer objections to a project powered by hydro and structured through shared governance. Even American energy buyers noticed. Several U.S. companies explored swap deals to access Canadian LNG indirectly, an ironic twist given the political motives behind the tariffs. One analyst from Energy Futures Group noted, Canada isn't just exporting gas, it's exporting trust. As of August 2025, LNG Canada was operating at 82% of planned capacity, with additional expansions in negotiation. New terminal proposals in Prince Rupert and Goldboro were dusted off and re-evaluated with fresh urgency. Canada didn't just adapt, it advanced. A fragile standoff today, both nations find themselves locked in a complex and uneasy standoff, one neither can fully win nor afford to lose. In the U.S., energy firms are lobbying hard for tariff exemptions. Pipeline operators argue that reduced Canadian flow is not just hurting business, it's undermining regional energy security. Western state governors have petitioned the Department of Energy to reconsider the Canadian levies, citing increased price volatility and reliance on spot market imports from less stable regions. But Washington remains divided. The Trump administration views the tariffs as a show of strength, a tool to extract better trade terms and reinforce American LNG's global position. Rolling them back could be seen as political retreat, especially with an election season looming. In Canada, success brings its own tension. While LNG Canada operates at near capacity, the country's internal pipeline infrastructure, long designed to move gas south, now faces directional stress. New westbound pipelines are needed. Rail systems must adjust. Environmental assessments, though streamlined, still face scrutiny. Domestic critics argue that Canada is simply trading one form of fossil fuel dependence for another, risking long-term climate goals. Moreover, pressure is growing from domestic industries that once benefited from cheap gas. Ontario-based manufacturers and Quebec utilities now compete with Asian buyers for Canadian supply. Prices inch upward, margins thin. Meanwhile, Asia watches with quiet satisfaction. Japan, South Korea, and China now enjoy diversified access to LNG, with Canada as a neutral, reliable source. For these nations, North America's internal discord is a geopolitical gift, but the broader cost may be harder to quantify. The decades-long energy bond between the US and Canada, built on mutual trust, infrastructure, and interdependence, is unraveling, not from war or disaster, but from policy choices and political posturing. A relationship once taken for granted now feels fragile, conditional, and transactional. And yet, the two economies remain deeply intertwined. Power grids, industrial supply chains, and climate strategies span the border. If the energy relationship fractures completely, the ripple effects will extend far beyond gas flows. It could redefine how the continent handles climate, resilience, and its place in global markets. The question now isn't who won the last move, it's how long either side can afford to keep playing this game. Impact on Canada. At first glance, Canada's LNG breakthrough looks like a clean win. But beneath the headlines, communities and companies are already feeling the growing pains of success. In Kitimat, British Columbia, the town at the center of this energy pivot, a boom is underway. Hotels are booked solid. Restaurants are overflowing. Housing prices have spiked 24% in less than 6 months. The LNG Canada terminal brought jobs and investments, but it also brought pressure. Local infrastructure is strained. Roads designed for timber trucks now handle daily convoys of tankers. Schools face teacher shortages as new families arrive faster than the system can absorb. And while the provincial government celebrates export milestones, nearby Indigenous communities are divided. Some welcome the economic opportunity, others raise environmental and sovereignty concerns about expansion projects. But it's not just Kitimat. In Ontario and Quebec, manufacturers accustomed to stable Canadian gas prices are seeing their input costs rise. Feedstock prices for petrochemical plants in Sarnia are up 18% since June 2025. One mid-sized plastics producer recently paused hiring plans, citing volatility caused by international demand. The surge in exports, while lucrative, is tightening domestic availability and squeezing traditional consumers. Meanwhile, new pipeline proposals face a crowded, contentious future. The Prince Rupert LNG corridor, meant to ease Kitimat's bottlenecks, is already drawing opposition from environmental coalitions and rural municipalities fearing construction disruption. Canada's pivot to Asia is working, but it's not frictionless. The economic gains are real, but they come with trade-offs: infrastructure pressure, regional inequality, and a national conversation about energy direction in a climate-focused world. As one analyst put it, Canada built a highway to Asia, but forgot to widen the roads at home. Impact on the United States. For American businesses and households, the cost of the tariffs is no longer theoretical. It's showing up in monthly energy bills and canceled projects. Take Washington State, where utilities have historically depended on Canadian natural gas to meet winter demand. Since the third quarter of 2025, cross-border flows have dropped sharply. Puget Sound Energy, one of the region's largest providers, reported a 12% increase in wholesale gas prices due to constrained supply and higher shipping costs from alternative sources. Some plants have begun stockpiling LNG from the Gulf Coast, transported thousands of miles by rail, a far less efficient solution. In Oregon, A small paper mill in Klatskani was forced to suspend operations for 3 weeks in September due to unpredictable gas prices. The facility, which employs over 150 workers, cited tariff-related market instability in its filing with the state. Even further inland, cities like Boise and Salt Lake City are beginning to feel the effects. Previously buffered by access to Canadian supply, they now face tighter regional markets and higher volatility. Industrial users in Idaho report fuel cost increases of 9 to 14% in Q3 2025 alone. And it's not just industry. Residential consumers in the Pacific Northwest have seen winter heating bills rise an average of $24 per household. In colder, rural regions, where margins are tight and incomes modest, this is more than just an inconvenience. It's a real hit. But perhaps the most symbolic impact is political. Enbridge's canceled $1.4 billion pipeline expansion through California sent shockwaves through the infrastructure sector. Jobs were lost, investors pulled back, and confidence in U.S.-Canada energy coordination eroded. For policymakers who had hoped to strengthen North American energy independence, the result has been the opposite: fragility, fragmentation, and rising frustration. And still, no clear resolution is in sight. The U.S. tried to flex economic power. Instead, it exposed how deeply it relied on its neighbors' resources, and how quickly those relationships can unravel when politics overtake pragmatism. North America is standing at a critical intersection, one paved with decades of cooperation, but now riddled with mistrust, tariffs, and diverging strategies. Canada has asserted its independence, building new pathways to Asia and claiming a seat at the global energy table. The U.S., once the continent's energy gatekeeper, now finds itself scrambling for control, facing rising costs and a shrinking sphere of influence. Neither nation is entirely right or entirely wrong. What's clear is that energy security, economic growth, and geopolitical relevance no longer flow in just one direction. So now the question isn't who can win alone, but whether either side can truly thrive without the other. In the race to define the future, will North America win together or fail apart by going it alone? Are you American or Canadian? Share your story and your perspective in the comments below.